So let's resume the session. It's now up to me to present the next topic on the agenda, sustainable finance in Portugal. Now we will have Carlos Martins, here on my right, speaking on behalf of the ESM. First of all, why the ESM? So the European Stability Mechanism and its predecessor, the EFSF, is very much related with the Eurozone debt crisis of 2010, which in turn has everything to do with the onset of the financial crisis of 2008-9. The ESM mission is to enable the countries of the euro area to avoid and overcome financial crises and to maintain long-term financial stability and prosperity. ESM can provide financial assistance to euro area countries experiencing or threatened by severe financial problems. This assistance is granted only if it is proven necessary to safeguard financial stability of the euro area as a whole and of ESM members. The ESM has on its toolkit several instruments. It can grant a loan as a part of a macroeconomic adjustment program, such as the one that was already used by Cyprus and Greece, namely. Ireland, Greece and Portugal have used also similar programs delivered by the EFSF, and the only other instrument used was an ESM loan to recapitalize banks, which was provided to Spain. Apart from these instruments, the ESM has also created the Pandemic Crisis Support, a credit line available to ESM members to support domestic financing of healthcare, cure and prevention related costs related to the COVID-19 crisis. This credit line was available until the end of 2022. So, a few words on Carlos Martins. He is a principal portfolio manager of the Investment and Treasury Division of the ESM, where he manages 20 billion euros sub-portfolio. He joined the EFSF in 2012 and is responsible for investing part of the 80.5 billion euro paid-in capital, in line with the ESM investment guideline. He has been working in fixed income markets for over 17 years, helping develop the ESM asset allocation, the ESG strategy, and the investment framework since its inception in 2012. Furthermore, he has also participated on an EMF technical assistance mission as a reserve management expert. Carlos is also focused on the EU taxonomy development, being an appointed observer of to the European Commission platform on sustainable finance as an ESM representative. Prior to joining the ESM-EFSF, Carlos spent over 6 years as a proprietary trader for a Portuguese investment bank, covering a vast array of fixed income instruments and focusing on global macro trades. On his academic background, Carlos is graduated in economics at the University of Aveiro, Portugal, got an MSc in finance from Lancaster University Management School, UK, and is currently a PhD student in economic and social history at ISEG here in Lisbon, and a visiting lecturer at Universidade Católica Portuguesa de Porto. So, Carlos, the floor is yours.
Well, thank you very much for this thorough introduction. Thank you very much for the invitation. It's a real pleasure to see that in Portugal we're finally going to get some traction on the topic of sustainability. I've been doing a bit of these presentations and discussions for the last 3-4 years, but only very recently we started having this more intense discussion in Portugal, which I greatly appreciate. Secondly, of course, the only thing between lunch and you guys is me. So let's get started and see how can we make a good discussion out of this. So as we may have understood, we have myself, my background is more from the investment side. And this is the perspective I would like to bring to you today. And I'm going to change the slides from here because it makes more sense. So why are we here? The first point is we are here because the world needs us and needs change and needs the investment community to also be part of this change and this transition. We observe the climate change impacting our lives, impacting our economies. We have seen these effects throughout prolonged effects in the climate, but also a more frequent and intense climate events. So we can already infer, and going a bit to some questions that were here in the previous panel, we can only see that this means risk. And this is the key point when we're talking about investments. Climate change affects risk perception. When we look at an investment point of view, I always like to bring, sorry, I'm going back and forth, so sorry for that. When I look from the investment point of view, I always like to bring this table because it shows you the full scope on when we consider ESG and sustainability from an investment point of view. On one hand, we have the conventional investment style in which, of course, we look at risk return from a very traditional approach, not caring at all with any ESG or sustainability factors. On the other hand, on the other scope, the other extreme, we have the philanthropy. And somewhere in the middle, we need to be assessing those risks and those returns. And that's where sustainability kicks in. Then I'd also like to mention that from the European point of view, there is, and most of you have seen this, but there is a big scene, a big picture that we need to understand. And there are some bits and pieces of this puzzle that are being brought together in order for us to understand how can we actually deploy a difference in our approaches in life from a policy point of view, but also from an investment point of view. From here, I would like to highlight that the disclosures that are being forced to companies is one of the key instruments that has been deployed. And this has been brought essentially by the CSRD that's been developed with the SRS. We're going to talk about that later. But also, and I think very importantly as well, the regulation in terms of investment funds with the CFDR. At the core of all these things, we have obviously the taxonomy. And the taxonomy is a big breakthrough that we have seen in the last couple of years that will help drive investors. The taxonomy is in fact directed to investors. But before I go into detail to that, I'm going to just maybe go a bit back and try to understand why, oh sorry, in the wrong direction. Trying to understand where did we get here. From today's perspective, we've seen a lot of green products, and we understand that investors are very comfortable looking at how can we invest in green assets. But back in 2014, this was not the case. We had a quite self-regulated market. There were pretty little intentions from investors to care about sustainability. And we start having some supranational entities that start thinking, how can we finance this transition very earlier in that day? So we have the EIB, the European Investment Bank, creating the climate awareness bonds, which was the precursor of what we call today the green bonds. And the green bond market actually was one of the biggest achievements that we had in the market, and I'm just a bit forward here, that we had in the market from a self-regulated point of view. So when we say that, well, we need to regulate the market because the market will never help the transition, that's partially true. But market cared about these things, I would say from 10 years almost. So we had this big evolution in terms of green bonds, in terms of social bonds, in terms of sustainability bonds, what we call use of proceed bonds, in which markets try to earmark and try to finance their green projects, their social projects. Now, we can always argue that, well, this is not enough, we need to regulate more because we need to make sure that we're not suffering from greenwashing. Absolutely. And this is clearly true. But nevertheless, market participants have been investing into, in this case, green bonds and social bonds, sustainable bonds from a long time ago. And if you look into these graphs, the global ESG issuance of bonds hit over $1 trillion. And this is quite remarkable. So regardless of what we may think about financial markets being focusing on returns and the traditional risk return approach, it is a remarkable achievement what we've seen so far. We had, of course, a change of context lately with the change of interest rates that affected somehow the amount of green bonds, the use of proceed bonds have been issued, but nevertheless they remain quite high. And also very importantly, Europe is leading the way. And this is one of the key messages I would have for you today, is that Europe, despite all the problems that we may point to the European construction, is leading the way in order to finance this transition. If you look at the right-hand side graph, you see that roughly half of the use of proceed bonds are issued in euros. And if you look at where this is coming from, is issued in Europe. So Europe is leading the way. Now, we can argue and we can debate what are the consequences of this priority in policy making. And of course there are adverse consequences. Obviously, when we're focusing on the transition, when we create the green program to finance this transition, the Green Deal, of course we are focusing on the transition, on the green activities, and this has consequences that we need to care about. First of all, let me see if I have a good graph on this. Yeah, no, it's not this one. Oh, I'm going backwards. Sorry for that. Yeah. When we look at this financing of the green transition, we know that this will affect many points of the economy. It will affect first and foremost the companies, because they need to make that transition, and that has a cost. It needs to probably change their business models in order to adapt to that transition. But as it mentioned in the panel here before, it has consequences on the labor force too. So we need to understand how we can help make that transition also from a labor force point of view. We're going to most likely have a disadjustment between supply and demand of employment that needs to take care of. And then we have other sorts of problems. First, on the domestic markets, we will see different sectors behaving differently and acting differently towards transition. Some of them have an easy way to make that transition and therefore are prepared for that transition. Some others, they need time and they need money to make that transition. And that's just in the domestic market. There's a usual, very well-known concept in the sustainability world, which is called stranded assets, which basically means that if your company or your sector or if your area of business is running into potentially risks of not being profitable anymore due to regulatory changes or needs to make the carbon transition, then you have a risk in the medium-long term for your company. And therefore, you need to make a plan. You need to adapt. You need to be prepared for that change. And that's one way to look at the domestic market. Some sectors, they need to make that change, that transition, in order to avoid becoming a stranded asset. But then we have the other point, and this is something that we've been discussing quite a lot these days when we see the demonstration of farmers in Brussels or in Paris, which is how can we deal with the short-term impact on the competitiveness of our own domestic agents vis-à-vis the external world. As I said, Europe is leading the way towards the transition, but that has short-term costs. that we need to address. We need to have the buying in of everybody to make this transition. And those costs we're starting to see that are becoming more and more evident. The competitiveness of our agents towards non-European companies, non-European players is severe in some points. We need to make sure that the regulation that we put in place is fair in a way that European players are not in a disadvantage towards our peers outside Europe. And if in agriculture we're talking about more specific things like very specific regulation towards the usage of soil in the production of our food, in other sectors this becomes more evidence that we need to make sure that this transition is made in a just way. So the just transition is something that you've been hearing a lot, and we'll be hearing a lot more in the upcoming years, because it's exactly this. We need to make sure that the people are actually aware that we need to make this change, but at the same time do not suffer in a way that make that change impossible. But in any case, what we're trying to make out of this framework is exactly to make sure that agents that step in our domestic market actually follow our own rules. And even if you look into our US counterparts, they make sure that they continue to be very competitive, even if at the cost of not providing as much information, as much disclosure, or not be obliged to provide how much emissions or greenhouse gases they emit in their own supply chain. So, going a step back, what we have here, and let me go back up here. What we have here is the whole framework that we need to put in place. And one of the key issues that we need to address is obviously exactly how to make that disclosure and how to make sure that we know what is a green company. This was a question that we had in the platform for a long time, and we still do. And I'm looking at Fabiola there, and she's confirming it. What is a green company? So the answer, and my students, by the way, when I ask them, okay, we're talking about Tesla, and we're talking about some other companies, is it a green company? And they start saying, yes, but no, and we have a good debate, but we really don't have a conclusion. And that's a good thing. And that's exactly what the taxonomy tries to do. So the taxonomy will try to bring, let me see if I come back with a nice slide here. Sorry for that. Oh, I'm going back and forth, not good. Sorry. I'll do that. So the taxonomy, most of you have seen this slide many times, but the taxonomy will try exactly to do that. It's a classification tool. For as much as we discuss what is the path to transition, if we discuss the criteria in which a company may be green or not, the taxonomy will tell you for each economic activity if that economic activity contributes to one of the 6 environmental objectives defined by the Commission, and if it doesn't do any harm to the other 6. And this is very fine. It allows us to say, okay, this company is green or not, or is partially green, or is has a certain percentage of their greenness in their turnover, OPEX or CAPEX. But the key point about the taxonomy that is usually missed, actually 2 key points about the taxonomy that is usually missed, is 1, the taxonomy is directed to investors. So the taxonomy is a tool for investors. It creates the transparency, the comparability, and the trust for investors to make sure that when they invest in a certain company, that company is, according to the criteria, the technical screening criteria that is implemented in the taxonomy, is actually green. And that's a very good thing. It's actually one of the biggest achievements that we have in the last years. When we're talking about those green bonds back in the day, one of the biggest problems we're facing, and mostly investment funds as well, one of the biggest problems we're facing was exactly greenwashing. So taxonomy was the biggest answer to the greenwashing risks. Let's not forget that sustainability is mostly, first and foremost, let's put it that way, about avoiding greenwashing. And then it leads to the second point. Why do we need this taxonomy? Well, the taxonomy incides in 3 main pillars that we need to look at. It's turnover, OPEX, and CAPEX. And we're discussing a bit here before in the initial panel, in the previous panel. And I would like to talk about those three points and why they are there. I think Andres was doing a very good job explaining why we need capex, and it is important to know why we focus on these 3 points. As we mentioned, the turnover represents what are currently the mission, the business of any company. So it gives you a dimension of the present day. It basically tells you what is the company doing today. The OPEX, although it gives you the same feeling, it also gives you a feeling of what has the company been doing in the past and what is the legacy of their balance sheet, so what kind of operation expenditures they are still doing these days. But the CAPEX, and this is what Andrews was saying very well, the CAPEX tells you how is the company thinking about doing next. What is their plan? So to have these 2 dimensions, the time dimensions on CAPEX versus turnover and OPEX, it tells you where the company is today and where is the company going tomorrow. And for that, sorry to go back and forth here. Should have done this in a more easier way, but sorry for that. Sorry for that. Yeah, that's fine. So, in that sense, we can already understand that some companies, some sectors, are actually much more advanced than the others. Some sectors have an easier way to do this. And this is something that we've been looking at in a platform in the last year. I'm looking at Fabiola again. But this is one of the most interesting features that probably taxonomy will start allowing us to look at, is how are different sectors behaving vis-a-vis their capex and in respect to their own emissions. So it gives you a sense, one, how much capex is green, first of all, and secondly, how much potential of transforming the full capex into green capex. And then I go to my usual speech on this section, which is we have a gap. We have a big gap in terms of investments. This comes from the intermediate report from the platform, one of the subgroups regarding the capital flows, and it tells you how much money we need to make this transition. And it's a lot of money. The Green Deal is a trigger to channel funds to the economy. It's not the solution itself. The idea is to trigger funds from the private sector as well, to pull in order to make that transition. So the estimate that we've seen is that we're going to need 620 billion euros a year until 2030 in order to achieve the goals. It's a lot of money. It does not come from the public sector. The public sector does not have this kind of money to make this transition. One point is, do we need the transition? I think the answer is an obvious yes. Is it expensive? It's extremely expensive. So how can we finance this transition? And there are 2 ways. None of them is very easy. The first way, as I mentioned, is to transform the full capex into green capex. And that gives you a bit of the needed transition financing for that. But that's not enough. So we're gonna need to come up with a lot more funds. And there are not many ways to do that from a company point of view, from a private sector point of view. One is the clearest way to do this is to expand that capex, right? It's to invest more. So companies need to invest more. How do we do that? So companies don't have many choices in order to expand their capex. There are only 3 ways, roughly speaking. One is to increase their debt levels, so to increase their leverage ratio. Some sectors are more leveraged than others, but most of them are relatively already quite pushed in terms of leverage. The second is to gather more equity, and that's usually the most expensive point on the balance sheet. And the third one the most likely one that we've been looking at in the last few years is about retained earnings. So companies need to understand that in order to avoid becoming a stranded asset, in order to avoid the risks of transition, in order to face physical climate risks and financial risks stemming from the climate change implications, they need to invest more and retain less earnings. So these retained earnings, they can be seen in many different ways. So again, we're going back to the turnover and to the capex point of view. So they need to get that turnover and make sure that those profits are retained and transformed into capex. So there are many ways we can look at that. First, companies pay dividends. So should they change their dividend policy in order to finance more capex? Second, they do shares buyback. It's a very used tool these days. It's equivalent to dividend payments, but more useful in terms of market timing. And the third one is to make sure that those earnings that are retained for other reasons are really directed towards the capex increase. So we need to do that. We need to increase those levels of capex. And again, this is why the taxonomy makes such a difference. But of course, there are a lot of constraints. The first constraint is profitability. So we are looking again at the risk-return point of view, not just from an investor, but from a manager or a company point of view. So they need to make sure that that transition is into a profitable new business model. The other level constraints is, of course, the rigidity of those dividend payments. So that's something that they need to face. And when you look at these risk returns, the traditional way tells us that investors care about risk return. So the way forward is to embed into the risk profile the ESG concerns, not just the sustainability point of view, the full ESG concerns on the risk point of view. And from my perspective, this is the point where the difference can be made from an investor point of view. Sustainability, despite many papers that have been seen regarding how assets perform better or worse, whether they are more or less green, they never tell you with very much certainty that there will be a higher alpha for greener assets. This is usually not the case, or it's not robust enough to be a broad case. But from a risk point of view, yes, we can have less risk from green assets or socially aware assets, so ESG assets if you want. So this is where we actually can act from investors. So one of the questions actually was raised, how investors look at this and why should they buy green assets or ESG assets? And one of the reasons is exactly because the risk should be lower. So if a company is greener, the company should be better prepared to face climate change, climate risks, sustainability risks. And therefore, in the medium long term, they should have a lower risk. So if you face the comparison, the decision-making process of any investor to look at a green versus a non-green asset, then we may easily go to the conclusion that the green asset has less risk. And that's one of the key points. The other points that I also need to mention here is that, as we've seen before, the sectors are very different, and they have different capacities to adjust. The policy in the last couple of years has been focusing a lot on the greener sectors. They've been promoting the greener sectors. What we need to talk a lot more in the next years is how to finance the less green sectors, how to make sure that those that have a higher cost of transition can get the opportunity to make that transition. Just an example, if you look at services, for instance, they have a very easy way to make sure that they have a very green capex or a green business. But if you look at those heavy industries of construction or other sorts of sectors that have a lot of pollution emissions, greenhouse gas emissions, those sectors, they need a lot of money to make that transition. So the priority of the policy, in my view, needs to be directed as well to those sectors and actually help those sectors to make that transition in order for them not be left behind. We need those to be brought in. But on a positive note, this, where we are today, is a much better place than we were 2 or 3 years ago. 3 years ago, we had no idea what was a green capex. We were not even talking about capex at all. We are talking today about capex because of the taxonomy. And now we know how can we finance that transition. We need investment, we need innovation for this, right? So we are in a much better place to make decisions because we know where we need to act. And what I usually comment in here is that from investors' point of view, we're always facing two big pillars. One of risk return, as I mentioned before, and the other one is choice. And the taxonomy, it's not a prescriptive, imposed plan for investors. Taxonomy is a choice. It makes you decide better. It makes you decide with more transparency, right? So in a way, to complete the taxonomy part here, it's all about choice. Taxonomy does not force investors to buy green assets. It's not about that. So taxonomy helps you decide whether or not you want to invest in those green assets. And then if we move forwards, this is replicated in other points of our framework, of our EU sustainability framework. If you look at the SRS, again, we're talking about disclosure. We're talking about information. So investors will make more informed, better informed choices. It does not force companies to evolve in any point their data points of the SRS. It does force them to know where they are. It does force them to collect data in order to publish and to disclose that information. It does not force them to evolve in that sense. But the market forces in here, this is one of the, I think, better approaches that I've seen the Commission take in the last decades, is that we're looking at all this regulation not as an imposed evolution, but actually as a choice, a nudge. And that's a very important understanding on how the market works. So the market can decide to invest into greener assets. It can decide to make their decisions, better informed decisions, more transparent companies because they publish their CSRD reports with the SRS information, with the taxonomy alignment embedded, but they don't have to. This is quite remarkable. This is not the way usually the EU Commission usually works. And this is a very, very important point. And if you look at the CFDR, the fund industry is exactly going the same way. So we have, for those that are not very familiar with this, we're having 3 different articles for types of funds. So we have Article 6, 8, and 9. Article 6 for funds that do not follow any, I think I have a slide on that. Let me see if I can figure it out so I can talk with those in front of me. Just bear with me. I know lunch is coming, but I'm coming. It's not here yet. The green one. No, it's not here yet. Yes, here. There we go. So we had Article 6, basically funds that had nothing to do with sustainability, but they need to mention the sustainability risks. If you look at the traditional perspectives of any funds, they traditionally need to mention the risks that the funds are facing. The only addition here is that they need to upgrade those risks, including the sustainability risks. That's all. Then we have Article 8 and 9. We can call it light green and dark green. So what we were looking at in the past, before SFDR was launched, was that there are a lot of funds saying that they were green or they were sustainable. And this regulation allows the market to organize themselves. If they are green, well, tell me how green are you, right? If you are really, really about being green, if you really want to be dark green, well, just comply with Article 9 and you'll be seen as a green asset, right? Again, investors are not obliged to buy Article 6, are not obliged to buy directly Article 9 or Article 8. They can buy Article 6. It's their own choice. It's about risk return, right? But they know the risks, and they know what's the policy of each fund. And that makes a huge difference. So again, we are in a much better place today than we were before this type of regulation came through. And this, again, is very important from an investment point of view and how we evolve as a financial market. So funds, nowadays, they categorize according to this. And again, the risk of greenwashing is greatly avoided, if I may say, according to this. Of course, if you go back to the US, words like ESG are highly politicized. So again, Europe is leading the way towards sustainability in this sense, but there's no other way than saying that Europe actually enforces funds to avoid greenwashing and to make investors, even the retail investors, to make sure that they really know what they're investing in, and promoting and channeling funds towards the transition. Now, let me just go back a bit here. I'll meet on time, okay?
5 minutes.
5 minutes. I'm almost there, no worries. Oh, wrong way. Sorry. I'd like to talk about something in Portugal and I'm done. All right. I lost a lot of time here. There you go. So, from economy point of view, we need to reshape the economy. But this regulation actually allows us to do this. So the whole perspective of this regulation is to put together the different economic agents in order for them to have a cohesive approach towards the transition. So if you look at, obviously, the CSRD companies, so the large companies, they need to disclosure the taxonomy alignment, they need to make sure that they make a transparent report on the ESRS data points. So we need to know how they are regarding ESG, basically. But, as we know in Europe, the banking system is the glue, is the main financing tool for companies, either SMEs and to a large extent also some of the larger companies, although those ones actually issue a lot of bonds too. So for the bonds, we have the EU Green Bond Standard, which will be related to the taxonomy. It's something that will come out, it's out there, but it will evolve as soon as we start looking into more details of the taxonomy as a result of the published reports. But I like to focusing here is on the banks, because the banks will play the crucial role to help the SMEs get into this cycle. The SMEs are obviously not included on the CSRD, but they do need somehow to report, and this is highly expensive for SMEs. It represents a high cost for SMEs. So the banks will play a crucial role, and they are already playing this role of actively cooperating with the SMEs in order for the SMEs to have their own disclosure in terms of sustainability. Why? Because the banks have the right incentive. They need to report a lot of things, including their green asset ratio, their taxonomy alignment. So in that sense, the banks will require the SMEs to do that. And probably, and I've seen this happening already, the banks will help the SMEs to do that job. Right. Just to finalize, and I know I'm pressed on time here now, just a small point. Sorry, I need to show this. Okay. So, 1 minute. So here is where we are in terms of the prospect of achieving our goals, right? So the goals we have is 2030, 50% of the 1990 emissions, and by 2050, the neutrality, right? So as you've seen, until now, basically, the speed of decreasing of our emissions has been such that would not allow to reach our goals. So we need to accelerate this. We need money, and we need to accelerate the transition, right? And some sectors need to do it faster than others, but we need to make this. So whenever I present this, my students are asking, oh, but we're so slow in the first years. Yeah, well, the rest is actually a projection, eh? So we actually need to make it faster. So anyway, that's one point. And just to finalize, oh my God, I'm only going in the right direction. Just to finalize, I've been picking up a bit what's happening in Portugal these days. And what we've seen is that one thing. First, we are roughly on track on the carbonization mode, basically because the sectors of the renewables is actually helping a lot. But it depends if we take the neutralization or not. But we had the big peak in 2005. So basically we went in the wrong direction from 1990 until 2005. And we're catching up on this relatively fast. So Portugal actually is doing okay. So we kind of expect Portugal to, with more or less difficulty, to actually achieve those targets. But we do need to finance further innovation in the country. That's absolutely sure. But, and this is something I always like to highlight just to finish, we always say, well, Portuguese economy is made up of SMEs. Well, yes, they are 99.9% actually of the registered companies in Portugal. But they represent, let's call it roughly half of the turnover, right? So this is only half of the story when we say that the SMEs is 99% of the economy, because half of the story is large companies, although there are only 1,500. Those will be probably obliged to report. But still, we need to make sure that not just the SMEs do their work, and they have to do their work, although it's much harder for SMEs to do this kind of work, especially the older ones. But the large companies, they are mainly where we need to focus, because from a supply chain point of view, once we have the buying in from the large companies, most probably the SMEs will follow through. And I think I'm done for today. If you have any questions, talked a lot. Sorry for that. Lunch is coming, I hope.
Thank you very much, Carlos. That's a lot of food for thought. We are a little bit behind of schedule, but in any case, I'll allow some 5 minutes for a Q&A period. Who wants to take the lead? Microfone, por favor.
Hi, hello. Similarly to EU green bond standard, is there any plan for sustainability-linked bond standard?
Oh, thank you so much for the question. I actually forgot about that. So one of the components that we've been looking at throughout this last 10 years of evolution of sustainable finance was actually exactly the appearance of the sustainability-linked bonds or sustainability-linked loans. Let's not forget they were created by oil and gas companies initially and widely used by those. I can't deny the usefulness of those. So if a company wants to use those kind of tools to finance their transition, there's no problem about it. Let's start with a positive note. But there are some issues. It's what economists call the agency problem. Sustainability-linked loans or sustainability-linked bonds, they finance the general expenditure of the balance sheets, contrary to use of proceed bonds, which finance projects or specific projects or economic activities. So in that sense, we cannot say that those finance sustainable transition. It finances whatever the balance sheet is doing. What they implement is KPIs. So they set targets, sustainability-linked targets, and there lies the problem. So do we have the trust or the confidence that companies will put up ambitious targets into those SLBs? That's the question. And up until now, what the market has been doing is buying a lot of those. So market clearly either doesn't care or trusts that those targets are ambitious enough to be set there. Now, what we've seen as well is that, so first of all, let's step back. Those sustainability-linked bonds usually have what we call a step up in the coupon. So basically, if the KPI is not achieved, there's a penalty for the issuer. That's usually the traditional structure. Up until now, there are not many cases where the KPIs were not achieved, which proves that maybe the targets were not very ambitious, maybe. But a few weeks ago, or not long ago, last month, there was a case where one of the companies that was issuing SLB actually admitted that the KPIs were not achieved, and therefore there was a step up in the coupon. Suddenly, we start understanding that there is an embedded option in those coupons, that it's not as far-fetched as an unambitious KPI, but actually can have that step up. So the discussion on SLBs, for me, is not clear. I see the positives of it. There are a lot of companies that do not have the enough structure to pay for the structure cost of an use of proceed bonds. So SLBs is a useful way to do it. But we need to trust that the KPIs are ambitious enough.
Thank you. Anyone else? If not, I will take the chance. I have a small question. Oh, okay. Finn, Theo, please.
Thanks so much, Carlos. What I found really interesting is when you described a bit the capital flow from a corporate finance perspective, also on the earnings side. So I think I actually heard you for the first time in the panel where you talked about revenue is the realized capex from a while ago, right? OPEX is what you do to maintain that capex, and then new capex is the, right, so past, present, future. So I very much enjoy that. The earnings side, and where the company actually gets the funding for the capex, right? Because that's probably an interesting link between what Andreas was talking about and what you mentioned is, well, you have revenue, and then you have the retained earnings, and that could be deployed as capex. And then you can also have capex, then it's deployed through financial markets. And I wondered from an investor perspective, how, besides companies go to bond markets and to banks to borrow for capex, how do you look at this link between sustainability of the revenue model that could also justify the future capex, or how do you look at this revenue retained earnings perspective as an indicator, let's say, that the company would be well positioned to deploy the capex well? I'm not sure if the question makes sense. I'm just trying to understand this deployment of capex. Does the source of the funding matter?
Well, thank you. Thank you for the question. It's actually at the core of what we're trying to do. So, first point, the capex today should translate into earnings or turnover within 5, 6, 7 years. So that's the first point. So, whatever an industry or a corporate is investing today in capex, it should translate. So otherwise, they should not do that capex, right? It should translate into returns, into earnings within a reasonable amount of time. So we expect that to be transformed into turnover. Capex today will be transformed into turnover into 5, 6 years. But answering to your question, how do we do this? How do we make sure that today's earnings actually can be transformed into capex in a way? It depends on the sectors. But the return earnings reality is that I take it from a risk point of view, right? So if a company it's not preparing for this transition, the current turnover may start to lower in the future. This is the key point for me. So whenever you invest in green capex, it's not because it's fluffy, it's because you need to have a more robust business model in the future. So you need to make sure that that happens. But you also know that if you don't do that, your current level of turnover will start declining. If we are correct that climate change will have an impact on the economy, and I think we all agree on that. So the companies that have the highest risk of being affected by climate change and climate risk they should prepare the levels of capex either by retaining more earnings or increasing their debt levels to invest more in order to at least keep that levels of revenues. Otherwise, they risk going out of business. I think risk is the answer here. I'm not sure I answered the question.
Thank you. I think I have to close the Q&A period. I also had one small question on the ESM investment policy, but we can do it bilaterally later on, so we have plenty of time until the end of the day. So, Carlos, many thanks for this enlightful, fruitful discussion. We are now closed for the lunch break and resume in this very same room at 2 o'clock sharply. Thank you.